New York is like a city with a plague. The bodies of suicides lie in the streets. Saving banks are empty. Ruin and tragedy prevailed. Stockbrokers' offices are besieged by desperate speculators. New York, a city of fear, suicide and crime. 700,000 investment charges. Empty saving banks. They have not sufficient money to lend. Big shops unable to tempt the impoverished customers with cut prices. No sale for motor cars. Those quotes were mentioned by the Sunday Star on December 1st, 1929, found in this article with a social-economic dramatical approach. Here are explained some of the consequences that the United States and even Europe suffered because of this terrible tragedy that we will clarify below.
The Wall Street crash of 1929, also known as the Great Crash, was a major stock market crash that occurred in 1929. It started in September and ended late in October, when share prices on the New York Stock Exchange collapsed. It was the worst decline in US history. The Dow Jones Industrial Average dropped 25%. It lost £30 billion in market value. The 1929 stock market crash lost the equivalent of £396 billion today. It was more than the total cost of the First World War. It destroyed confidence in Wall Street markets and led to the Great Depression.
But when did the Great Depression start? Many people think it started with the October 24th crash, but it really began months earlier, when the market fell 10% in a March correction. This is demonstrated in this informative article that warns of the get-rich-quick phenomenon and also announces that citizens should not worry about this drop of the falling market.
The first day of the crash was Black Thursday. It immediately fell 11%, signaling a stock market correction. Trading was triple the normal volume. Wall Street bankers feverishly bought shares to prop it up. The strategy worked. By the end of the day, the Dow was down just 2%.
On Friday, October 25th, the positive momentum continued. The Dow rose 1% to 301. Short trading day on Saturday removed that gain. The Dow closed at 298.97, according to measuringworth.com. On Black Monday, October 28th, the Dow fell 13% to 260.64. The next day was Black Tuesday. The Dow fell 12% to 230.07. Panicked investors sold 16,410,310 shares. In this objective negative news, we can observe the panic of an investor that led to his own death, shooting himself for the great losses of the stock market. The week of the stock market crash began with another down day. On Tuesday, the New York Times headlines fanned the panic with articles about margin sellers, short sellings, and the exit of foreign investors. In this section of a newspaper, we found a rather amazing event. It is a negative news that informs us that the market value has been reduced to $5 billion in the last wave of the previous minute. The day before Black Thursday, the Washington Post headlines blared, "Huge selling wave creates near panic as stocks collapse," while the Times screamed, "Prices of stocks crash in heavy liquidation." By Black Thursday, panic had set in for the worst stock market crash in history. This news has an informative and negative approach. It explains that sales have dropped considerably, approximately one-third compared to the previous Friday.
The crash followed an asset bubble. Since 1922, the stock market had gone up by almost 20% a year. Everyone invested, thanks to a financial invention called buying on margin. It allowed people to borrow money from their broker to buy stocks. They only needed to put down 10 to 20%. Investing this way contributed to the irrational exuberance of the Roaring Twenties. The crash wiped people out. They were forced to sell businesses and cash in their life savings. Brokers called in their loans. when the stock market started falling. People scrambled to find enough money to pay for their margins. They lost faith in Wall Street.
In this section, we can see that it is reported that there has been a new crash in New York, which predicts a worldwide panic. This is the most expensive in 5 years.
The 1929 stock market crash was a result of an unsustainable boom in share prices in the preceding years. The boom in share prices was caused by the irrational exuberance of investors, buying shares on the margin, and overconfidence in the sustainability of economic growth. Some economists argue the boom was also facilitated by loose money, with US interest rates kept low in the mid-20s. The most catastrophic stock market crash in the history of the United States, Black Tuesday, took place on October 29, 1929, and was when the price of stocks completely collapsed. It all started a half a week earlier on Black Thursday, or due to Europe's time difference, Black Friday. This was a time of incredible instability. During the 20s, real estate values were on the continuous rise. However, by 1925, values of real estate in the United States had peaked and were beginning to drop. This is known as the start of the chain of events that led to the Great Depression. During the late 20s, Americans speculated a lot and invested money that they didn't even have. Brokers were known for lending investors more than 2/3 of the value of stock they were purchasing. This resulted in over £8.5 billion to be out on loan.
Because investors kept hoping that the price of stock was going to continue going up, people were encouraged to invest. Considering the fact that the price kept going up, people will get greedy and hope for it to go up more before pulling out. This speculation resulted in an economy bubble where the price-to-earnings ratio was up to 32.6 in September of 1929. When a PE ratio is this high, it becomes dangerous and could lead to economic problems. Fortunately, some economists proposed ideas to alleviate this great crisis. John Keynes proposed that the state had to intervene a bit in times of crisis to stimulate the economy. This was radically opposed to the ideas of Adam Smith's non-interventionism, which since 1776 was the dominant thought in the United States. It was thus possible to create employment for this large mass of unemployed. When these people managed to increase their purchasing power and overcome the economy of the country, it is said that, finally, this crisis had been overcome. This news of 1954 talks about the economic growth that was recovered. The Dow Jones average rose considerably, and that has been the largest ever since the famous crash of '29. We have searched all this information in the Library of Congress, chronicling America, historic American newspapers, in the way that is seen on the screen. In addition, we have found all the historical context in other pages, such as Wikipedia, Economipedia, and other blogs. This is the end of our project. We hope you enjoyed this explanation and that you understood in a better way the crash of New York of 1929.